Symbolism over substantive reform or change at this stage?
With regard to the A shares, yeah, I mean, clearly, as Tom was just saying before, the initial impact right here, right now, is modest. And just to rehash and repeat the numbers here, we're seeing just under 230. There's a couple of shares that are suspended, so it's actually 228 A shares that have been added to the MSCI China Index. And that's happening in two tranches. The first one is happening actually today. Second one at the end of August. Collectively, there's going to be 5% weighting altogether for the as far as the inclusion factor goes, and that will lead at the end of August, early September, to a weighting in the MSCI Emerging Market Index of 0.8%. And we think the associated flows around that will be something on the order of $22 billion US spread over those two tranches, as I just mentioned. So in the early days, when you compare that $22 billion of inflow with about 60 to 70 billion of average daily trading volume for the China equity markets onshore, it's not huge. But the symbolism, in our view, is very, very important, because over the longer run, as the inclusion factor rises, and there's very good precedent for this with Korea, with Taiwan, with other markets, and this, as you said earlier, is the second largest market globally, the inclusion factor will undoubtedly rise. And we've done some pro forma estimates which suggest that if you get to 50% inclusion factor, or even 100 in the longer run, maybe on a 5 to 7 year view, you could be looking at a weighting of something like 17%, 17, in the MSCI Emerging Market Index. So China will go from a very small sliver currently, China A shares, to a very significant chunk, and perhaps even larger. And if you look at the A shares plus the existing H that are already in the index, you could see China being more than 50% of the MSCI Emerging Market Index on, say, a 5 to 8 year view. And that is very consequential. It means that institutional investors globally will need to take this market very seriously.
And some would have to, wouldn't they, Tim, ultimately? What does it mean for the H-share, A-share dichotomy?
So, I mean, Rashad, it's a great question, and actually we think both look really good here. So we really like China. It's our favorite market within the region, and we like both sort of sleeves of it, if you would. And the underlying dynamics for each, I mean, of course, they share the common denominator of the macro fundamentals, and then you have to look at them each in terms of their specific index composition, the sector allocations within each one, as well as their valuation and so forth. Now, broadly speaking, both of them are trading at attractive multiples. The industry distribution is actually significantly changing and becoming more balanced. I mean, previously one of the so-called knocks against the H shares, and more specifically against the HSCEI index, was that it was too, say, bank heavy or old industry heavy. But of course, with last year's inclusion of the ADRs in the United States, which are very tech heavy, as well as some of this reconfiguration which is going on, you have a much more balanced set of sector distributions, and one that is much more veering towards the so-called new China or new economy areas, which are a focus of investor attention. So bottom line is we like both areas. We think that A shares are incrementally more attractive because they're trading at 12.1 times forward earnings versus 12.6 for the offshore stocks. And you get an additional undiscovered sleeve of stocks or under-researched sleeve of stocks, which we think offer some alpha opportunities for overseas institutional investors.